Joining us now with her second half playbook is Tiffany McGhee, CEO and Chief Investment Officer at Pivotal Advisors. Tiffany, great to have you back.
Great to be here, Caroline.
Second time this month. You were on at the start of June, and back then you were arguing that market leadership was broadening, that concentration risk was becoming a bigger concern. Is that what we're seeing play out right now?
Yeah, absolutely. So we think about how market leadership is broadening. It's a continuation of the same theme I was talking about. When we look at emerging markets, highest performing asset class up 29% year to date. Even in addition to asset classes, also size and style. So we think about value versus growth. With all of this talk about Mag 7 and AI, I think investors tend to think growth, but value is up 16% year to date versus growth, which is up about 4.5%, right? So that's a really big difference. And also small cap stocks are leading, up almost 21% year to date. So it's this transition away from these mega cap tech companies and really just broadening overall.
So the Dow and the Russell are the only major indices higher on the week. We're seeing pretty significant weakness in the NASDAQ this week. The S&P 500 is also lower. Should investors be preparing for more weakness in tech then, or is this just sort of a healthy digestion period?
I think it's a little bit of both. And so again, I think that we are conditioned to think that with a major positive theme like AI, everything's going to go up in a straight line. And you and I both know that's not how it works. It's not how the market works. So I always expect some volatility, and we're definitely seeing that in the past week. If I was an investor sitting home thinking about how I should be positioning portfolios. Diversification, I always preach the gospel of diversification, is really, really key. And I look at the fact that U.S. equities represent 60% of the market, of the global market cap right now, right? So I think investors are really, if you're invested in a S&P 500 fund, or if you're in that kind of traditional 60-40, where like 10 or 20% of that 60 is invested globally, you're making really big bets on a handful of companies and one country. Right, so just thinking about how you can kind of diversify that portfolio. There are a couple of things that we do to kind of buoy the portfolio. One is having a core and satellite approach, where you're using ETFs, passive strategies to get broad market exposure, but then you're also kind of peppering that with active management to really go where the index can't go, emerging markets, small caps. Also, we use this, there's an asset class called defensive equities, defensive equities. So some people call them liquid alts. Think of it as a hedge fund strategy, but liquid, right? Trading on an exchange, accessible by everyone, but it really kind of helps to buoy those really strict moments of volatility. And then just making sure when you're rebalancing, which you should be having, all investors should have a disciplined rebalancing strategy, that you're doing so being mindful of region and country.
Okay, so I want to break all of that down, especially the core and satellite, what should be in the core, what should be in the satellite.
Yeah.
But before we even get to that, you mentioned that portfolio concentration is really the biggest risk right now. So if someone owns an S&P 500 fund, if they're doing the whole Warren Buffett VOO, sitting in that, are they actually diversified, or are they just making a bet on a few specific companies?
They are. They are not as diversified as they think that they are, right? And they are making a big bet on a handful of companies, and also just, again, region and country-wise, one country, which is the U.S. So again, I think it just really requires a little bit more thought and a little bit more, vigilance with portfolio.
So if I'm sitting in VOO or VTI, do I trim those positions? Do I stop adding to them, or do I just simply diversify around them?
Yeah, so it really depends on what your entire portfolio looks like. If your entire portfolio is VOO, you definitely need to trim a little bit in order to diversify that position.
Okay, so talk to us about what the core positions should be?
Yeah, so again, we think about core and satellite in two ways. Asset class, but then also we at our firm, we say we've got a budget for risk and we have a budget for fees, right? So we always want to be fee conscious. So one of the things that ETFs or passive strategies allow you to do is get that broad market exposure, but also save on fees. So yes, I'm a big believer in things like VOO, right? You want to buy the broad market, but there are certain areas where the index is not efficient, right? So I would never index emerging markets, right? So we think about why we would invest in emerging markets. Well, the big one is China. We want access to those billions and billions of Chinese consumers. The index is not necessarily going to get you there, right? We want access to China A and China H shares. So thinking about how you can get that.
How do you get that?
And first of all, I'm a big believer in active management and to do so in a fund, right? So we're sitting here in the US, we probably don't have boots in the ground, right? As a regular investor just sitting home, you definitely want an active manager who has experience investing in those countries, who has boots on the ground. I talked about JP Morgan emerging markets. Last time I was here, Goldman Sachs also has an emerging market.
Just give us those tickers really quickly if you can.
GMEX is the Goldman Sachs one, and JP Morgan is JEMWX. Yeah. So and these companies, especially Goldman Sachs, they were investing in mainland China before most US companies couldn't invest there, right? And that required a lot of money. It used to be that if you wanted to invest in mainland China, you had to pay. And Goldman Sachs just happened to be the type of company who had, the means to do so. And we also want boots on the ground. We don't want a manager who's sitting in New York City, we love New York City, who's just making bets on places far, far away. Not just China, places like Brazil, India, those kinds of things. We want managers that have teams with boots on the ground, who maybe are from those countries, who can speak the language, who understand the culture and the opportunities.
Okay, so you've made a big case for emerging markets, international markets, as part of the core portfolio. What else should be in there?
Yeah, so I talked about defensive equities. Really, and retail investors have access to things like that. And so there are a lot of different companies who have these types of strategies. Again, we call it defensive equity, but they are hedge-like strategies. A manager that we use is called Globalt, and they have these kind of defensive equity strategies that are really in line with an investor's risk tolerance, whether you're more conservative, but there's a way to do it depending on your risk tolerance. Also, real assets, I think I've talked about that before. Real assets is one of the asset classes that really buoyed our portfolios in the first quarter. Again, January, February, great. March, everybody, we all woke up and it's like, wait a second, the world has changed. And so that, with our clients, since we manage money for institutions, we are graded on a quarterly basis. So while we're looking at markets, not, every month, every week, every day, our clients are grading us quarterly. And so we thought everything was going well January and February. And then again, March went a little bit crazy. So our real asset portfolio was up 13.1%. So we do that in an ETF strategy. We use a manager called Metis. It's great, but there are so many real asset ETFs out there.
And real assets, just break that down for us.
Yeah,
what does that actually mean?
So we're talking about real estate, REITs, we're talking about infrastructure, we're talking about some commodities, we're talking about minerals. There's just, we want to invest in all of it. We don't want to play the game where we're picking one, because some of those things kind of play like the leadership game. We want to own all of it. And again, for the first quarter, our real asset portfolio was up 13.1%. That, our defensive equities, and also private credit. Private credit has actually been doing really well. We kind of go a little bit further and do like an opportunistic credit kind of strategy. Those three asset classes for us really saved our clients in the first quarter.
And how should investors be thinking about tech right now? Given the fact that the Mag 7 is actually weighing on the returns of the S&P 500 right now, is that a buying opportunity? And is tech part of the core portfolio because you have exposure through the S&P 500, or is it a satellite play and maybe you're focused on something like memory after Micron's earnings?
Yeah, so I think tech is such a I hesitate to call it a theme, because the theme implies that it's going to be fleeting or passing, and tech is such a big part of everything that it has to be integral in the portfolio. I think whenever I think about tech companies and someone asks me that question, should we get on the bandwagon or what should we be doing? I think about that moment in Jurassic Park and like that first movie where the guy says, life always finds a way, right? And so for me, and when we're talking at our firm, we're having these conversations, tech always finds a way. It is innovation, it's progress. And so we believe it's always going to find a way. Yes, we're going to have these moments of volatility. We're certainly seeing that. And of course, we cannot talk about tech right now if we don't talk about AI. And we're thinking about what is the best way to invest in AI. We don't necessarily want to chase all the Nvidias. I mean, yes, we want to be in that, but it's moving away from just Nvidia, Alphabet, Microsoft.
So are you saying that you shouldn't be stock picking right now and you should be investing more in funds, or you should just be moving away from Mag 7 and choosing other names? If so, what are they?
So I think it depends on what kind of investor are you. So we like to pick stocks, but we also like managers, and I think that there's a way to do both, right? And to do both in a way that the investor feels comfortable with. But in terms of our AI trade, we don't want that to be held to 3, 4, or even 5 stocks. Again, we're thinking about this from a broader perspective. So we think about, I think I talked a little bit about this last time I was here, when we think about that first wave of AI, it was the creators, right? The Nvidias, the Googles, the Microsofts. Those are the companies that are really creating this technology. But now, and we have been for a while, there are the builders, right? We want to own the creators, we want to own the builders. The companies that are building the infrastructure around all of this AI to make it go, right? The heating, the cooling, all of these things. And then that third part are the adopters, these companies that are helping other companies harness the power of AI for efficiency, for production. So companies like Omnicell or ServiceNow, all of those companies are what I would call builders. So you have to own the creators, you have to own the builders, you have to own the creators, the builders, and the adopters.
Give us a list of a few names. I know you said you don't like to put it into 3 to 5 names, but give us 5 names that you actually like right here.
Yeah, so I will say, when we talk about companies like Nvidia, like Microsoft, first of all, I assume that everybody's in those already, right? So if you own an S&P 500 fund, if you own a NASDAQ fund, you should be invested in those. If you're not, then you should definitely invest in them. And I understand that those, that those are relatively expensive, but I don't think that you can afford not to be in those, right? So those are the first things. When it comes to the builders, there are a couple of companies that I think don't get talked about enough. One is Vertiv that I really like. It's cooling and power systems for data centers. I think it's up over about 160% year to date.
But not too late to get in now?
No, I don't, because these are the companies that I think are going to do very well later. So it's like, do you want to own them or do you want to wait? We don't want to play that waiting game, right? We think that we need to own these things right now, because eventually people are going to start really talking about them. There's going to be a spotlight on them, and then they're really going to be expensive. A couple other ones, Train Technologies, up 26% year to date, but they just did a deal with Nvidia, right? It's also cooling systems for data centers. But to do that deal with Nvidia, that's amazing. So that is something that I would buy right now. Also, Modine Manufacturing, more of like a mid-cap stock. So again, thermal solutions for these data centers, up 105% year to date. These returns seem great, and again, you're asking, should we get into these? I don't think you can afford not to be into these right now.
Micron's earnings this week really enforced the fact that AI demand remains strong, but now there's this new kind of wrinkle, and that is just the memory chip costs seem to be a big concern right now. We've certainly seen it weigh on Apple shares. Apple says it's going to be raising prices because of them. Does that change the AI playbook at all?
No, because if you're thinking about the AI playbook as a diversified strategy, again, I go back to creators, builders, and adopters, and not just one from each of those categories. You should be in, if you're going to do a single stock portfolio, you should be in 5 or 6 or 10 of those, right? So you have to really hedge your bets, and you have to be in, I think, all of these companies, or you can do so in a fund. You can do so in a combination, going back to that core and satellite, of ETFs and active management.
How much of a traditional portfolio, as we think about the second half of the year and some of this weakness that we're seeing in tech and how far it's already run for some of these names, how much of a portfolio should tech represent? Yeah,
so I think that that's a little bit tricky, because there are a lot of people, I think about the people who have 401ks, right? So not necessarily like that high net worth individual who's got hundreds of thousands or even more in a brokerage portfolio. What about the people who are just investing in their 401k or 403b? Chances are you are heavy in tech. So I think that, again, it requires a lot more thought and a little bit of vigilance. Not just putting your retirement portfolio into a target date fund and setting it and forgetting it, but being a little bit more thoughtful about how that target date fund is managed. A lot of these are a hybrid of passive and active strategies, which we really prefer. And so it's really hard to say how much of tech. I would say probably no more than 20 or 30%. However, I think if you're doing that in a diversified strategy, I think that puts you in a much better position than just going after the Mag 7.
Okay, so just final piece of advice before we get to our rapid fire round to the everyday retail investor as they think about where the market goes from here.
Up. I do.
You had an 8,200 price target.
I do.
You sticking by that?
I had I think I said between 79 and 82. So I'm just going to be still in that range, 79 to 82. I think it's probably going to be closer to the 79 than 82, because since I was on, we are seeing this volatility. But volatility is not a bad thing. It's a buying opportunity. But I do think that the end of the year, this is higher.
Okay, and just finally, what's something that investors should not be buying on the dip right now?
SpaceX. Yeah, I think that investors should really be thoughtful and not chasing these big name trends, right? So,
no Micron, 7% off the high?
If you don't have it, yeah.
Okay.
But again, it's not just when it comes to tech and AI, we're not going to get there in 1 or 2 or even 5 stocks. We're going to get there in probably about 30.
Okay. All right. Great time to pivot to our rapid fire game of this or that. You've played before.
Yes.
You know how this goes.
Yeah.
Quick questions, quick answers. Going to start with the second half playbook. Are you ready?
Yes.
Second half, stay the course or change the playbook?
Depends on the playbook.
What's the playbook? Quickly.
If you are diversified, then stay the course. If you are not diversified, then change the playbook.
Play offense or defense?
Offense.
Lean in or lock in gains?
Lean in.
Momentum or rotation?
Rotation.
Market broadening, temporary or durable?
Durable.
One sector poised to benefit most from broader market leadership?
I'm going to go with industrials.
Market's next leg, AI winners or everything else?
Everything else.
Concentration risk, overrated, underrated?
Underrated.
Index funds or individual stocks?
Both.
AI trade, early innings, late innings?
Still early innings.
Small caps or large caps from here?
Small caps.
Mag 7, trim and rebalance or hold and diversify around them?
Well, if you're trimming, you're still holding. So trim and rebalance.
Okay. More attractive today, Micron or Western Digital?
I'm going to fall for it, Micron.
Workday or Adobe? Both big losers.
Oh, I'll go with Workday.
Apple after price hikes, buy or avoid?
If you're not in it, which would be surprising, buy.
Tech stock on steepest sale right now?
Oh. Maybe we can go with Micron, 7%, right?
Sitting in cash right now, smart defense or a costly mistake?
Costly mistake.
If you had fresh cash today, where would you put it first?
This is so hard. Private credit.
Okay. You've given a lot of names in this interview, but 3 must-own stocks for the second half.
If you don't have Nvidia, you have to be in that. I don't care how much it is. Vertif, Train Technologies, and Modi.
Okay, we'll take 4.
Yeah. Oh, sorry.
Market for the rest of 2026, volatile or resilient?
Resilient.
One word to describe how you're feeling about the back half of the year.
Confident.
Tiffany McGhee, always a pleasure. Thanks so much for joining us here at the desk. That's Tiffany McGhee, CEO and Chief Investment Officer of Pivotal Advisors. If you enjoyed this interview, check out our Street Talk with Thomas Carroll. He explains why he thinks we're in the final stages of the bull market.